Hello and welcome to eLearn Markets. In this video, I'll talk about the difference between primary and secondary market. Primary market is where the company is directly participating in the market and issuing new securities, and the investors are buying these securities. Hence, they provide the funds to the companies. These securities could be debt or equity or both. Examples are IPO or NCD. IPO is equity and NCD or non-convertible debenture is an example of debt. Secondary market. Suppose a company does an IPO and it issues new shares. And say you as an investor buy the new shares offered by say XYZ and company. And say after 2 to 3 months, you as an investor are in need of cash. As an investor, you would have to go to another investor who is willing to buy those shares from you. But where will you find this investor? That's where the secondary market comes into the picture. Stock market is an example of a secondary market, a market where two different investors participate to buy and sell financial securities. One needs to note that the company whose shares are being traded need not be a participant in the market. Now, why the term secondary market? This is because the shares are second-hand, since these are the same shares that were issued during IPO. Now, in case of secondary market, if I am purchasing the share, the money is not going to the company as it was in the case of an IPO. It is going to the investor who's selling the shares. The company has already raised the money during the IPO, so this is a key difference between primary and secondary markets. Now we've all heard of Nifty and Sensex. Nifty is a stock index in India. It consists of 50 stocks which best represent the state or the health of the economy. Nifty is the stock market index for National Stock Exchange. Sensex, on the other hand, is the stock market index for Bombay Stock Exchange. It comprises of 30 stocks. NSE and BSE are the two major stock exchanges in India. There are others as well, such as MCX and NCDX as well. Now, circuit breakers. Circuit breakers are predefined values in percentage terms, which trigger an automatic check when there is a runaway move in any security or index in either direction. The values are calculated from the previous closing level of the security or the index. Usually, these circuit breakers are used for both stocks as well as the indices. Generally, when a stock or index moves sharply in either direction, halting or stopping of trade for a certain period or for the entire day is done. This is done to allow trading activity to cool down among the market participants. This time period also allows market participants to absorb any sudden news development in a particular security and then take a rational and measured approach during the rest of the trading session.